let's go ahead and bring in Martin.
Hey, Martin, I got a question before you get started.
Okay, Tom.
When you see these really volatile periods like we had back in January, late January, early February, and of course what we saw last week, does that change any of your, are you longer term? Does that not really bother you? Or how does that impact what you do with market?
Well, when you say does it bother me, do you mean does it make me more bearish or?
Does it affect any of your holdings or how you view the market and your positions, or do you kind of weather those storms and look elsewhere for your topping signals and those types of things?
Generally speaking, I'm looking at the longer term indicators and inter-asset relationships. That's what causes me to go bullish or bearish on a specific market.
Okay, so sentiment and the panic, short-term panic that's in the market really doesn't have that big of impact.
It has a big impact over the short term, but I don't think sentiment has a big impact over the long term, unless you're kind of at the top of a bubble, kind of like we were in the year 2000. That was obviously the top when you had huge amount of bullish consensus at the time, and technology stocks were all over the covers of Time magazine and Newsweek when they mattered, and so on and so forth. So there's different kinds of sentiment peaks and troughs. We tend to look at the shorter term stuff, but sometimes at a very long term turning point, you see different, more intense and more widespread sentiment.
Okay, well, normally I wait and hold my questions until after your presentation, but I thought with the timing, with you being on the show and the volatility just kind of screaming higher last week, I thought I'd ask before you got going, but take it away. I know you got a great presentation lined up for everyone.
Okay, so feel free to ask any questions anytime. And number one. Number two, could you give me a 5-minute warning when I'm close to getting to the end?
Okay, sure.
Please, thank you. So obviously we had a pretty nasty drop last week, and it's put a lot of shorter term indicators in a bullish mode, indicating that either we're going to get a sideways movement or we're likely to get some kind of a retracement rally. That's the good news. The bad news is, unfortunately, the collapse that we saw last week has done some severe technical damage to some of the averages, especially some of the overseas averages. So let's just take a look at the short term right now to kind of justify what's going on in terms of the bounce we've seen since Friday. This is a price volume oscillator, and the green arrows flag selling climaxes, and the blue arrows flag buying climaxes when the PBO has reached a high level and starts to reverse. So you can see last week we saw a buying climax. The question then becomes, what's the most likely outlook from a buying climax? Are we going to get a quick reversal like we did in 2016 here, and again in 2014? Or more likely, are we going to get a bounce, which we're seeing right now, and then a test of the low, and then a move to new highs? And that's, of course, a $64,000 question. And the answer is that most of the time, you can see in this case, there's 4 instances of a consolidation before it rises, and 2 indications of a quick reversal. So based on this quick survey of the last 4 years or so, it would suggest that we're going to see a bounce now and then a test of the lows later. That's also indicated by the next chart. If I get into my chart package here, there we go. This time we're looking at S&P versus the percentage of S&P stocks that are above their 50-day moving average. And the red line indicates when you get into oversold condition. And you can see what happens with the green vertical lines that I've got flagging those periods when we're oversold. Once again, this chart goes back to 2006, and it encompasses the 2007-2008 bear market. And you can see when we get an oversold condition in the bear market, we don't get much response on the upside. Sometimes we get a sideways movement. Sometimes it ignores it altogether, as it did over here and as it did over here. So in a bear market, when you get an oversold condition, it doesn't necessarily mean you're going to get much of a rally. Probably what you're going to get is some kind of a consolidation. Whereas in a bull market, which we're seeing over here, you're seeing much stronger recoveries from these oversold conditions. which brings us to the current situation where once again we've got an oversold condition. I'll just go into the last year and a half or so. The same chart, same indications, but this time we're looking at the period since 2015, and you can see that when we get a reversal from the oversold condition, you get a rally, and then you tend to get a reaction, and this happened in the last three occasions. So once again, it would suggest to me that we've had a bit of a rally already. So the question is, the answer, the outlook, I think, is that we're going to see a test of the lows before long. Now, the problem with all this is that we've done some serious damage. Here's the S&P back to 2016, and you can see it's broken this very thick line. And I made it a thick line deliberately because I want to emphasize the fact that it's a the extended line is a very important resistance area. So when we're above the line, it represented support, and from where we could expect to see a bounce, either actually touching the line or approaching the line, and consistently it did so. Now that role of support reverses itself to one of resistance. So I've emphasized that resistance by that very thick line. So it seems to me that the thing we need to worry about is the fact that we're probably going to get a test of this low, as indicated by these other oversold conditions and the selling climaxes in the previous charts. And that means that this line, this thick red line, of course, is going to continue to advance. So it's going to be very difficult for the market to get back above that trend line again. Also, we're looking at the other indicators which aren't so oversold. This is my Dow diffusion indicator. This is where we take a basket of Dow stocks and figure out which ones are in positive trends. And when they're all in a positive trend, we get a high reading, and when they're very few in a positive trend reading, you get a low reading, and that tends to be an oversold reading, and that tends to generate a rally. Well, one of the problems is that we broke this uptrend line back in mid-September in a similar way we did in January. And that didn't signal the end of the world, of course, but it did signal that we're going to probably see an extended trading range period, which is what we did see for a while until the Dow actually went up and played catch up at the time and made a new high. So this indicator right now is not even in an oversold region. It's just a little bit above. This is yesterday's close, just a little bit above the zero level, above the balance line. So it's not yet oversold. So there again is another reason for suspecting that we very well could see a test of the low. And that would also, in the case of the Dow, mean a test of this red line here, which is, of course, the 200-day moving average at 24,900. So when I talk about damage, I can point out to even greater damage being done around the world. This is the MSCI World Stock ETF. And you can see that initially, when I say initially, I guess the middle of this year, it started edging through this uptrend line here, going all the way back to 2016. And then the market crash last week, or we won't call it a crash, call it a sharp sell-off, I guess, caused the price to drop below this trend line here, which is sort of marking the top of a sort of a head and shoulders, a little bit of a shoulder here, big head and lots of right-hand shoulders here. Doesn't really matter what you call it. The fact is there's obviously a battle between buyers and sellers between these two trend lines, the green line and the red line. And the battle was won by the sellers because it broke down, and now we're seeing basically what we should normally regard as a retracement move back towards the extended trend line again. And it's also below its well below its 200-day moving average. So the world is not doing as well as the US. Now underneath we got my special K indicator. For those that are not familiar with it, there's a write-up on in the chart school. But basically what it does, it's a long-term indicator with short-term implications. What I mean by that is that we construct the indicator by adding long-term momentum to intermediate-term momentum to short-term momentum, and we get one big curve. And most times, I estimate about 70% of the time, this indicator will bottom along with the market. So here we see a bottom with a green arrow, and up here it's peaking with the market so far in January. This is the World Stock Index, of course. And so if it does that about 70% of the time, it's very easy when you've got looking at the hindsight to go back and look and see where the peaks and the troughs were. The point is, how do we know that in real time? And the answer is we look for trend line violations and we look for a crossover of the signal line here. And because it's a fairly jagged indicator, because it's got the short-term momentum stuff in there, we can actually sometimes draw price patterns. Well, at this point here, obviously, it looks like both of these series, certainly so far, peaked in January on track. But there was no trend violation in the special K, which we've now seen with this trend line break and the fact that it's moved below its signal line. So as long as it stays below this green resistance trend line, I'm marking this indicator as in the bearish camp. And you also notice that it made a new post late 2017 low, whereas as the index itself did, as the price itself did, which sort of indicates the two are kind of in gear on the downside. Further moving on to the global scene here, we see this is the Dow Jones World Index, which is a similar indicator to the ACWI. One of the reasons I like this one better on the StockCharts platform is we can go back with a much longer history. We can go back to the 1990s. But you can see the trajectory is very similar, whereby we reached a high in January. We saw a trading range break down from the trading range below the moving average, and now we're tracing back to the trading range. So it's very similar to what's going on with the ACWI. You also notice that we have the global AD line, which is constructed from daily plurality of a basket of individual country ETFs, rising or falling, same way we would do with the vast decline line on the NYSE or the NASDAQ or in these other indicators. And in this case here, it's broken below this uptrend line going back to 2016. So the advanced decline line has broken as well. It's just around its 200-day moving average. It was a little bit above it yesterday. But the big thing is it's a decisive break below this trend line here. So that all suggests to me that we're having some problems in the global market here. We're also having some problems in the US market, because here we're seeing the NYA, which I think is a better measure of the market than the S&P, because it includes all the stocks listed on the NYSE. And I've drawn another thick trend line here. It's a difficult trend line to draw, because when you're drawing a trend line, you want to draw a line which sort of basically reflects the underlying trend as best you can do it. And in this case here, it was breached a couple of times, which I don't mind seeing it breached once. I don't like seeing it breached twice, but it seemed to me this is the best way of drawing the trend line, where it intersects with as many different points as possible. And you can see that each time it comes down to the trend line. You couldn't even hold below this trend line for very long. So the trend line represents support, so it couldn't hold below the support, which really emphasized the importance of the support. So anyway, here's the trend line, and once again, you can see that we're seeing a tracement move back towards the trend line, the extended line. But it has obviously got some way to go before it gets through the trend line, and created some pretty important damage, technical damage, by crashing through the line. So even though we got a short-term oversold condition, we'd like to get a rally. We already seen a bit of a rally take place, but probably able to hold below these lows for a while. We've still got a problem of getting above this extended trend line. And there's also a possibility it could be forming a head and shoulders top, because this red line here would represent the neckline. Here's the shoulders, there's the head, and this current rally would represent a possible shoulder if this red line, dash line, was broken on the downside, which is what, about 12,350, somewhere around there.
Hey, Martin.
Yes.
On that chart, I mean, how much consideration do you give? I mean, when you look at the beginning of 2016 through the beginning of 2018, the move from the bottom all the way to the top, that was a 50% move in 2 years. Now, I mean, I understand, with a trend line
from here to here.
Yes.
Yeah.
So you've got, I mean, it's up, what, 4,500 points, and it started from 9,100. So that's roughly 50% in 2 years, which is a lot to expect from a huge index of companies. I mean, it's one thing for a company here or there to go up 50% in 2 years, but for an entire index, I mean, should we be giving the market the benefit of the doubt to consolidate a bit more? That would be question number one. And then the other question I would have for you is, when you looked and I think it was the ACWI, which was that MSCI global market ETF. I just had a question on that as to how much weight you would give the February low, because even though we did break that trend line, we've been holding on to the February low that was established with a lot of selling. So
you're talking about this one here.
I'm sorry, what?
You're talking about this one here?
Yes. So that slight uptrend. Yeah, that slight uptrend broke. But if you look back to the low back in January or early February, we actually went right down and tested that price support off that initial selling and then started to bounce. I was just wondering how much, I mean, do the trend lines mean more to you than those initial pullbacks and price support? How do you view that?
Well, it depends on the nature of the trend line. I mean, to me, a trend line gets its significance from its length, the number of times it's been touched, and the angle of ascent or descent. If it's only been touched twice and it's a steep line and it hasn't lasted very long, I wouldn't give much credence to it. Mm-hmm. Same thing with a support level. If you come down and bounced on that support level a number of times, I give that much greater credence than I would a trend line. Also, if the violation of that support means you've now set up a series of declining peaks and troughs, that's another thing you'd be looking at. So it depends on the situation, really. In this case here, if this low here had been broken, you then have set up a series of declining peaks and troughs. So it was vital that the price hold below that support there. Now it's broken that support, and that really gets me quite concerned.
Okay. Perfect.
You asked me another question. I forgot what that was now. It was on this chart here, I think.
Yeah, it was on the dollar NYA. Yes, that one. I was just curious because we had risen so much in 2 years. You know, you were just talking about the ascent, the steepness of a rise. And over 2 years, basically the New York Stock Exchange rose 50%, which is, you know, pretty high for the New York Stock Exchange to rise that much in a short period of time. So my question was, would you expect maybe that the NYSE might take more time over a longer period of time to consolidate? And I mean, just my feeling is that those lows that we saw earlier in the year back in February and March are very important support lows, because that came with a lot of short-term panic in the market, and that's where the buyers stepped back up to begin buying. So I would be looking more like down around that 12,200 area as what I would consider more major support to allow the NYSE to kind of consolidate after these massive 2-year gains. So my question was whether or not you give that any consideration, the fact that we did go up 50% in 2 years, and maybe we just need to consolidate a little bit longer.
Yeah, there's very few examples of markets going straight up and straight down. 1929 is one. But generally speaking, after a big rise, you would expect to see some distribution going on, a battle between buyers and sellers that takes place. And the bigger the rise, usually what you would expect to see is a bigger battle between suppliers, between buyers and sellers. I wouldn't say that I would be waiting specifically for that to happen. If we now saw a quick break below this red dash line here, that would really get my attention, because it would mean it would have done a lot of it. Technical damage elsewhere with 12-month moving averages and so on and so forth. So it depends on the situation, Tom, in my view.
Okay, fair enough.
So one of the things which we've experienced in the last 12 months, I guess 10 months, is the fact that the U.S. stock market has outperformed the world. In this case here, we're looking at the SPX against the Dow Jones World Index, and this is a monthly chart. So this is pretty well for most of 2018. We've seen the U.S. market outperform the rest of the world, and clearly there's no sign of that abatement, because the 12-month moving average is still intact. This trend line is obviously still intact, and our long-term KST, which monitors moves around 9 months to 2 years, is in the early stages of a rise. Doesn't mean to say it's going to go up to 150 or 100, it could turn at any time. But right now, it's certainly not up here where it's overextended. And one of the reasons, it seems to me, for the superior performance of the S&P has been technology stocks, and specifically the internet commerce stocks, which, according to Dow Jones, have gone up by a factor of about 40 since 2002. That's a pretty huge, and since 2009, it's about a factor of 20. That's a pretty huge move, and sort of indicates a bit of a bubble to me. And so what I'm looking for are possible triggering point. If we buy the argument about the world market having peaked out, the NYSE having broken its trend line and looking vulnerable, if it's going to come down and we're going to see a bear market, what are the triggering points that we would expect to see, or the triggering areas that we should be monitoring that might be a bellwether for a bear market? And one of these, I think, would be the Internet Commerce Index, because it's come up so much. So one of the unfortunate things about this chart is I've drawn a trend line which actually isn't a trend line. And I've tried to save it several times this morning, and for some reason this particular chart is corrupted. But I just bring it out to point out that this is not really a trend line. I've drawn it as a trend line, but the program won't save it this morning where it touches at least 2 points. So it doesn't matter, because in the next chart I've got the weekly data for the same index, the Dow Jones e-commerce index. And you can see from 2009 that the e-commerce index is right at the moving average, which is the 65-week exponential. And it's also at this trend line here. And this is the relative strength of the commerce index, or the e-commerce index, against the S&P. It too is down at support. So this is what I'm watching very, very carefully indeed, because if this strong area of the market, one of the areas that's gone up nearly 40 times in the last 15 years or so, suddenly starts to crack, to me that's going to ring a bit of a bell that maybe the rest of the market is likely to follow suit. And so we can take a closer look at this index, I think. Yes, we can. So now we're looking at a period since 2016, and you can see it has broken this trend line. And based on what I was telling you about trend lines before, fairly long trend line, it's been touched or approached on numerous occasions. I don't know, countless occasions on the way up, and now it's below that trend line, and it's below its 50-day moving average and its 200-day moving average. A little bit oversold right now, so it's done some serious technical damage on the shorter term chart. Because you remember the longer term chart, we had a longer term trend line, which you're right at. So if we see maybe a bit of a bounce and a retracement here, and then a move down below the previous lows, that would be quite a serious thing, because it would also break down on the previous chart. But right now, it looks a little bit oversold. Here's the relative strength of the e-commerce index to the S&P. It's obviously formed a head and shoulders top. There's the shoulder, there's the head, that's the shoulder. There's the neckline. It's broken below that. It's broken below this uptrend line going back to 2017. So the relative action has done some serious damage. I think it's likely to consolidate a bit in the next couple of weeks, because the short-term KST for relative action has just started to turn up again. So we just take one more chart of this index, and here we're looking at this top, which has been completed back here in beginning of the month. Now we're seeing a bit of a retracement move towards the breakdown area. There's the 200-day moving average, which it's well below. The RSI is interesting, because during the bull market, you don't expect the RSI to get into oversold territory for very long. Sorry, you do expect it to get overbought for a long period of time. It's oversold, you don't expect it to get to, and if it does, it tends to bounce significantly quickly from the oversold condition. In this case here, it doesn't show any oversold readings except here, which suggests that we may be in a bear market, because here's the peak of the bull market perhaps, and the secondary peak was unable to get to an overbought reading. We've been unable to get to an overbought reading during this whole summer, early fall period, but we have achieved an oversold reading. So that is a little bit of a hint that the character of the RSI may be hinting a bit at a bear market. So anyway, what we're seeing right now is that bounce that we were looking at in the previous chart, because the oversold condition in the KST and the oversold condition in the RSI. And also that may be the right shoulder of the head and shoulders top. There would be the left shoulder, there will be the head, and this would be the right shoulder. So I'm not forecasting that's going to happen. I'm just saying that's a possibility. And if it does break significantly through that trend line at 1060, we'll say down to 1055 or something like that, that would then complete this head and shoulders top. So one of the areas to look for triggering possibility is the tech area, specifically e-commerce. Another one I think that has traditionally, or actually in the last bear market, signaled a problem was in the junk bond area. So this is the HYG, which is the iBox High Yield Index, High Yield and ETF. And it looks to me like it may be forming a head and shoulders top. It's gone through here a couple of times, or it went through here once, has started to bounce again. So we're going to have to wait and see, because that was one of the causes of problems in the previous bear market. And so the thing I would be looking for, less so on the price of the HYG, but more of its relationship towards government bond prices. So here is the S&P just here, and underneath is the ratio of the HYG high yield bonds against the 7 to 10 year Barclays ETF. So this is junk bonds against government bonds. And the idea is that when the indicator is coming down, it indicates people are rushing towards safety because they're losing confidence. And when it's rising, they're moving more into the high yielding HYG and less into the governments. And that means their confidence is rising. So what we're seeing here is these red lines here, or red arrows, which represent a subtle decline in the ratio as the S&P is moving sideways. And each of these bear markets or mini bear markets was preceded by some kind of a divergence in this relationship. Well, fast forward to the present time, and you see there is no divergence between the two. So this potential triggering point doesn't appear to be likely to be one of any cause of any bear market that we might see going forward, which it was in 2000, it was in 2007.
Hey, Martin.
Yeah.
Actually, if we can go back, to that chart right there. First of all, we got a couple more minutes here, but I wanted to take a look at this and just kind of maybe explain the theory of this chart. I mean, is it that when you take the high yields and divide it by, say, government bonds, it's kind of a risk-on kind of an assessment? And
Correct.
So when you start to see this roll over, it means that traders are not nearly as aggressive and therefore could be pointing to future weakness in the market. Is that kind of how you interpret this?
Well, I would go further and say pointing to potential economic weakness, because you've got a high yield bond, it's not very good credit. And if you're going to get some trouble in the economy, credit defaults are going to increase. So that's really what it's all about. Players in the bond market expecting better economic conditions or weaker economic conditions, which would tend to trigger more defaults.
Okay. Sounds good. All right, we probably have another minute or so if you have a couple other charts you'd like to share with everyone.
Yeah, I've got quite a few.
That just means we're going to bring you back again.
Okay, so the third thing I want to cover, I guess I want to cover a lot more, but the third thing I'm going to cover is the other possibility of a triggering point, which would be higher yields. Because traditionally, when yields reach a certain point, that triggers a weakness in the economy, which then triggers a recession down the road. Stocks start to smell that out when the rates get to the cringe point, so to speak. And so rising yields at some point causes problems in the stock market. Well, here is the TYX 30-year yield, and you can see it's broken out of this lovely base here. And here are the short-term KST, the intermediate and the long-term. They have one thing in common. They are all rising. And that should spell trouble. But at some point down the road, that could spell trouble for stocks. I'd be a bit careful about forecasting higher yields, but sentiment right now is from a country point of view, is completely in the wrong direction from where you want to be if you're going to have higher yields. Everybody's bearish on bond prices. Everybody's bullish on bond yields. And the commitment of traders suggests that the people who know about these things, the hedgers, are actually close to a record net long position. So I'd be a bit careful about forecasting higher yields, but it doesn't matter. The triggering point to me is not the level of the yield, but how they interact with the stock market. And the way we look at that is with the stock bond ratio. When the stock bond ratio is rising, it means stocks are outperforming bonds. And when it's falling, it means that bonds are outperforming stocks. So this is the SPY against the TLT, which is the Barclays 20-year trust. And you can see that this ratio has just bounced off this very important trend line going back to 2016. And the special K, which we talked about earlier, is also broken this trend line up here. And so that indicates certainly a loss of upside momentum. And if it now starts, in fact, the next chart, I can show you this area in greater detail here. So you can see it's the uptrend in the special K is still intact because we made a new high here, but it wouldn't take much for it to drop below these two trend lines, the blue line and the red line. And also the KST down here is in a, I wouldn't say an overbought condition, but it's certainly in a bearish condition. So that's something I'm going to be watching very carefully. This SPY TLT ratio to see, make sure that it holds above this very important trend line. Because if it breaks below the trend line, then you know that rising rates are adversely affecting stocks. Or alternatively, it could be bond prices are going up because yields are coming down, and that's what's outperforming the stock market. So whatever way it goes, it's very important to watch this line here. So I guess I've used my time up. Is that right, Tom?
Yeah, but that's okay. I mean, first of all, I think that's a good thing, because I think what it does is just demonstrates the fact that so many of us here at StockCharts like to educate. We like to talk about, a lot of the theory that goes on behind these. I mean, I know you can talk for hours about these charts. Aaron and I do the same thing. It's always hard kind of to rein us in because there's so many things that we want to talk about. But there was a question that came up in the room, and I actually have a chart. Can I go ahead and show you the chart and then get your opinion, your thoughts on it?
Just before you do, I just want to show you this one chart here. This is the Shanghai Composite.
Okay.
It goes back to 1995, and you can see that seriously violated that secular uptrend line. So
Okay.
going back to what I was saying about the number of times it's been touched and the length of the line, that is a mega trend line, and it's decisively broken.
I would agree with you, and that's going to lead to a second question I have for you in just a minute. But the first one I want to show you is this chart. And the question that came in the room, and I think I'm getting the question right, but they were asking about the divergence between the New York Stock Exchange or the NYSE Composite Index and the S&P. And you indicated that the NYSE, in your opinion, is more important because it encompasses the New York Stock Exchange. Here you can see the S&P 500 broke out, but there's a negative divergence in that the NYSE Composite did not.
Right.
And the question was, what do you think of that? Does that have any implications?
Yeah, it's definitely when you're looking at identifying trend reversals, primary trend reversals, you've got to use the weight of the evidence. And this is definitely a piece of negative evidence that goes into that camp, that the NYSE, and it probably also undermines a bit about technology, because I don't know how to make up the S&P. I think it's what, is it 20% or 25% technology?
Arthur Hill would be the best one. I know he follows that really closely. I'm not quite sure.
It's the biggest weighting in the index, and that is why the S&P, one of the reasons that contributes to the S&P rallying to a higher level than the NYSE in October, September. You had another question, I think.
Yeah, and then the other question is, I don't know that we need a chart for this, but you talked earlier about how the U.S. is leading the world markets, and the question that came in is, do we have precedents here? In other words, have we seen periods where the world markets have underperformed like this for a long period of time? And does that eventually drag down the U.S. market? Or would it be the other way? Would the U.S. market kind of lead the world markets back up? What do you think there?
I think you better give me a coin.
Okay, that's a good answer. That's an honest answer.
I think it probably marginally supports the idea the U.S. is going to drag the rest of the world up. But remember, in I think it was 2015, the Chinese, or 2016, the Chinese market came down and dragged, and there was contagion dragging the US market down with it, albeit in a mini bull, in a mini bear market. But, I don't think, from what I've seen and studied, there is a hard and fast rule you can say the US is going to drag the rest of the world up, or the others going to. A lot of it depends on where you are in the cycle. And we're in a cycle that began in 2009. It's now 2018. What's that, 9 years? It's a long time.
Yeah.
And in that period, we've seen two mini bear markets, which have been associated with economic slowdowns. And it seems to me that we're turning over again in a lot of these leading economic indicators in terms of their momentum. What we don't know is whether that will turn into a slowdown in a mini bear market or whether it's going to be a recession. And we won't even use the word.
Yeah. Well, I know, when you're talking about that breakdown in China, I've looked at using the correlation coefficient at StockCharts. You can kind of look to see what is positively and negatively correlated. And to be honest, the Chinese market, the Shanghai with the S&P 500 doesn't have nearly the positive correlation that, say, the European markets do, especially Germany. And so when I see the China market breaking down, while I definitely think it's a negative, I would find it much more negative that Germany, for instance, just recently, the DAX just recently took out its earlier price support lows. I think, I don't know, around 11,800. I'm trying to remember. But anyway, do you have any thoughts on that before we pull up our poll?
Oh, I think the European markets look pretty sick too.
Yeah.
I didn't mean to pick on China. It's just that it just broke in that beautiful secular uptrend, which I wanted to show you. But
yeah, I agree with you. I agree with that.
In this case here, it's going to be very difficult for the US to buck the rest of the world. Really, what we're talking about is technology continuing to go up.
Right.
It seems to me.
Yep. And I think some of what's helping the US, obviously, some of that money is rotating away from some of these other markets and moving into the US, but that can only last for so long.
Well, it's organic. I think if you're a bounce decliner, it's a narrowing of the bounce, isn't it?
Yep. Okay, so we got our poll up here, and if a bear market's looming, what will trigger it? And higher interest rates is battling a bear market is not looming right now. So, did you have a preference here, Martin? Did you, if we truly are going into a bear market, which of these do you think is the one that might trigger it?
I'm going to wait and see what the evidence tells me.
Okay. I don't believe higher interest rates personally.
If I tell you something, it's only as good as my opinion. But if I show you a break in the charts, then that's what the market's telling us. So
yeah.
I don't be flippant about this. But that's what we got to look at, is what the evidence says. And obviously the ones that are closer to breaking down are the ones that are most likely to break down.
Yeah, one thing I would say about this interest rates, and maybe a little side feature here, and maybe this could have been another answer that we could have given to the group, would have been an inverted yield curve, because we are seeing that yield curve coming down quite a bit, and it's not far from the zero line now. Do you have any thoughts on that?
Yeah, I'd be a bit careful about using the yield curve because everybody else is. I think it's a great indicator. And what I've noticed is that what happens during a recession, or before a recession starts, the yield curve flattens like it's been doing now. And before the recession, it starts to steepen again, indicating a weakening economy. And we don't see that at this point. We're seeing it come down at this point. So I'd be a bit wary about looking at yield curves when everyone else is looking at them. But I still think, taken on a desert island in isolation, a yield curve is a very good indicator. But sometimes when everybody focuses in on an indicator, like they did in the 70s and 80s on M2 every Thursday or whatever it was, that tends to lose its effectiveness.
Got it. Well, I tell you, Martin, it was a pleasure, as always, to have you on the show. Some great insight into the market, and I definitely want to get you back sooner rather than later.
Okay, Tom, thanks.
Yeah, always great. Great information. There
Excellent.
he goes. Yeah, he is one of the best. There's no doubt about it. And I tell you, whenever I hear Martin Pring talking or writing an article, or John Murphy, the same thing. I mean, these are two, just titans in technical analysis that you definitely want to keep an eye on, listen to. So really appreciate having Martin on today.
With 3 unique service levels and multiple data plans to choose from, StockCharts.com makes it easy to customize your account to best match your specific needs. In this video, we'll help you explore all the benefits of your membership by explaining our service levels, data plans, and pricing. Let's see how it works. To start, you'll want to choose from one of our 3 service levels: Basic, Extra, or Pro. Each service level represents a collection of features and options bundled together. If you're new to StockCharts, our basic service level is a great place to start. At $14.95 per month, Basic will allow you to create larger, more powerful charts and save them to your account. Next up is our Extra service level, the most popular choice among StockCharts users. At $24.95 per month, it includes all the features of our basic level, plus more saved chart storage and the ability to create custom scans and alerts. If you want it all, our Pro service level is for you. At only $39.95 per month, Pro includes even more storage for your saved charts, custom scans and alerts, as well as faster auto refresh, historical data, and much more. For all service levels, you can choose to subscribe on either a monthly or an annual basis. Our monthly renewal option is similar to most other web-based subscription services. You pay for 1 month of service at a time, and your account will simply renew automatically each month. With our annual renewal option, you prepay for 12 months of service and we'll give you the 13th month for free. If at any point you'd like to change your service level or renewal preferences, you can always do so from the Your Account page. Now that you've chosen a service level, let's find a data plan that works best for you. Regardless of service level, all StockCharts accounts come standard with our free data plan, which uses BATS real-time data for the US and delayed data for all other markets. However, if you want to enhance your StockCharts experience even more, you can customize your account by adding official real-time data plans for one or more of the stock exchanges we support. Similar to exchange fees, prices for each plan vary, as they reflect the fees charged by the exchanges for your use of the real-time data. We want to make sure you have the data that's right for you, so our data plans are flexible and can be added or removed at any time. Keep in mind that all real-time data plans are billed separately from your service level subscription and always on a monthly basis. Unless removed from your account, data plans renew automatically at the end of each billing month. If you do choose to remove a plan, the change will take effect at the end of the month. All data plan charges are non-refundable. To explore all our data plans and update your preferences, visit the Your Account page. StockCharts.com gives you the charting tools and resources you need to invest smarter. And now with the flexibility to customize your service level, renewal cycle, and data plans, we make it easy to find the account options that are just right for you. Take control of your investing in just a few simple clicks with StockCharts.com, simply the web's best financial charts.
Hi, this is Arthur Hill, Senior Technical Analyst with StockCharts.com. Today we're going to show you how the market summary page works. Here are the topics and the timeline for today. First, we'll show you where you can access the market summary page. Then we'll go over the different parts of the market summary page. We'll show you the different viewing options, intraday, ETF, or combined. We'll show you how easy it is to add and remove columns to customize the page. Then we'll show you how you can sort by one or more columns. And finally, we'll give an example of using the search box. Accessing the market summary. There are a couple of ways to access the market summary page. I'm here on the free charts page, and you can see with that drop-down menu at the right, I have a link for free charts. And if you open up the browser, then you will get links up at the top for the main sections here at StockCharts. And on the right side of this free charts page, you have the summary pages, and there is a link for the market summary page. You can also access the market summary by clicking on the members link. And when you go to that page, you'll see the control center. And if you scroll down on the control center, you will see a selection for reports and analysis tools. And there you can click the market summary link. Parts of the market summary. The market summary page was designed by John Murphy, and it is specially designed to give you a quick impression of the major market averages and common indexes during a typical trading day or end of day, depending on how you like it. It's really handy. I find myself checking it throughout the day. Now, it's laid out in a top-down format. So you can see you've got the major markets at the top. Then you have the major indexes. So you can see how large caps, small caps, the Dow transports are performing. Then we go down into the sectors and then into the industry groups. So here you have one glance and you can see all the industry groups and see which are leading and which are lagging. Then we have the international ETFs. We have U.S. bonds in the form of treasury yields. And we have U.S. commodities. And these are ETFs, so you can track the intraday action. Finally, we have currencies and market breadth. And there are a couple of links at the bottom where you can click to get the end of day summary page and the McClellan Oscillator and Summation Index for the NYSE and NASDAQ. At the top and in the middle, you will see Market Summary 4, and there is a drop-down menu for selecting the different viewing options. On the left-hand side, you will see a column button, and you can click on that button to add or remove columns. Just below, you have different icons, and those are links for different charts for that particular line. Here it is the Dow Industrials, and you can see the name is also linked, so you can click on that for a sharp chart. Each of the column headings are displayed, and you can click on these headings to sort by that particular heading. And on the far right, we have the date and the time and a search box if you want to search the market summary. Now let's review the different viewing options. Chartists can use the drop-down menu at the top and in the middle to change the viewing option. You have intraday, end-of-day ETF, or combined, which is, of course, ETFs and indexes combined. Now, I'm not going to show you all the details and the differences. I recommend you look at these different viewing options to see which one works best for you. For now, I'm just going to highlight some of the main differences between intraday, end-of-day, and ETF. The first two differences would be with bonds and commodities. Here on the intraday market summary, you can see we have a handful of treasury yields, and we're using ETFs for commodities. And if you look at the end of day version of the market summary, you can see we're using treasury note and treasury bill prices because these are end of day prices, so you're getting the actual treasury bond. And if you look at the commodities, we're using continuous futures, and these are updated at the end of the day. Another area that has a significant difference would be in the market breadth indicators that are shown. Here on the intraday market summary, we have tick, trend, the McClellan Oscillator, and the volatility index. If you go to the end of day market summary and scroll to the bottom, towards the bottom, you will see an array of market breadth indicators. And we also have the bullish percent indices for you to follow. Now, both the intraday and end-of-day market summary pages show you the international ETFs you see here on the left. The end-of-day market summary page adds the major world indexes. So if you want to follow the German DAX or the FTSE, they're going to be on that page. If you're just interested in ETFs, then you can simply select ETF here. And now I've got just ETFs for the major indexes. The sector SPDRs, the industry indexes are now ETFs, international ETFs, the bond ETFs, commodity ETFs, currency ETFs, and the VIX ETF. And this is great for getting a quick overview throughout the day and at the end of the day of how the market is performing. Adding and removing columns. Chartists can easily add and remove columns by clicking the column button, and there you will see all the columns that are currently selected. So if I don't need the closing price or the name, I can click those and they will be removed. So now I just have the symbol and the change. If you want to add those back, you just click them again to add them. Sorting by one or more columns. I'm here on the bullish percent indices, and if I want to sort these, I will click the percentage change heading, and I can reverse that sort by clicking it again. You notice I have all these zero values. If I want to do a second sort on top of this first sort, I'll hold down the Shift key and click on the column heading for the second sort. So here I'll hold down the Shift, click on Close, and you can see now I've sorted within these zero values by the closing value. Using the search box. And finally, if you want to search for a particular word on the market summary, go into the search box at the top right. I'll search for gold, and you can see that three things pop up. I have a U.S. industry index, I have a U.S. commodity, and I have a bullish percent index. And that concludes this instructional video on the market summary page. Thanks for tuning in, and be sure to check out our other instructional videos.
This is a brief tutorial on using stochastics. Big word, but wonderfully simple. The idea behind stochastics indicator is that as the price moves up, the close tends to stay close to the highs, or the price action throughout the day tends to stay close to the highs. And as the trend weakens, it has trouble staying near the highs. The stochastics will point this out. And the reverse is true at the lows. So as price is declining, all of a sudden it stops always closing near the lows. So not to get confused with %D, %K, %R, that type of thing, Henry Ford started with the Model A and went B, C, D, E, F, G, all the way through to T until he came out with the Model T Success. And so when George Lane and his colleagues were doing that for stochastics, they kept working their way through, and they did the same thing. They used %A, %B, %D to try and find a rhythm that worked out nicely. So what stochastics does is it takes a range over the last few days. In this case, a 5-period stochastics would say that from this point to this point is 100%, and price closed at 82%. And then that would be %K, and then %D would be a moving average of that. And it's important to remember on stochastics, according to George Lane, there is only one valid signal, and that is the divergence on %D. So you're looking for the divergence on moving average, and I'll show you that on some real live examples. So here's Apple, and I've got these stochastics set up slightly different. So this is a fast stochastic, this is a slow stochastic, and you can see that it's much smoother. It's got these whipsaws taken out, and that smoothing function is what %D is changing for us. And then the full stochastics here, I've changed the period to 14 instead of a 5-period stochastic, just to show you that it gives you smoother signals, and so it's a little easier to trade with a 14 period, and that would be the default at StockCharts. But depending on how aggressive you want to be, you might find that there's a better way to trade. So all of these signals are important, but what the big clue you're looking for here is this positive divergence where things are improving while the momentum is coming down, and you're starting to see the stock whipping around at the bottom here, usually a sign that something's getting a little more volatile and you might get a chance. So, you know, a nice trade like this would be a great move of $30 or something like that, and it would have got you in relatively early. Here is USO, and what we want to show you on this particular area is you can see how the price is actually struggling to make any moves higher. And even though %K keeps banging on the top here, the %D, which is the moving average, this purple area, is moving down and making a lower high here. And it's that lower high that is our divergent clue that we want to be aware of. And then that's going to give us our sell signal. And in this case, we've got double divergence with another lower high way over here. And that is a real clear signal that George Lane likes to talk about. When you get those, it's a very valuable signal. So you're looking for the divergence on the moving average. And again, in this case, I've set up all three as 5 period moving average, but our default is 14, so you could set them up whatever way you'd like. And the way you do that is just select them from the drop down menu in here, and then pick the time period that you want.
You've got a problem. Your investments aren't growing as fast as you'd like. So you did a smart thing. You opened an online brokerage account and started learning more about the financial markets. But now you have a bunch of new questions, like which stocks should I buy? When should I buy them? When should I sell them? You tried watching the talking heads on the financial channels, but they just gave you untimely advice that the real pros already knew about. It's all starting to feel a bit too little, too late. But what if there was a way to know, to truly know, what the market was thinking and how it was behaving, even before the pros? What if you could learn where the market was headed while there was still time to profit from that knowledge? With StockCharts.com, you can. Trusted by thousands of online investors, StockCharts.com has the charting tools and analysis resources you need to make smarter investing decisions. Our intuitive web-based tools make it easy to create high-quality financial charts in just a few simple clicks. Save and organize the charts you're watching to make managing your portfolio a breeze. And when it comes time to buy, our unique technical ranking system sifts through the markets and quickly points you to the most promising stocks and funds. You had a problem until you found the solution at StockCharts.com. Start your free 1-month trial today and see what superior financial charting can do for you. StockCharts.com, simply the web's best financial charts.
I want to show you a little charting trick that I like to use for the percentage price oscillator, or the PPO. On this SPY chart here, you can see in the indicator windows, I've got 2 PPOs. The first is the traditional PPO. It's the black line there, and that's the difference between the 12-day EMA and the 26-day EMA. And you can see it's above 0 when the 12-day EMA is above the 26-day EMA, and below 0 when the 12-day EMA moves below. The red line is the signal line, and it's set at 9. So it's a 9-day EMA of the PPO, and you can identify downturns and upturns in the PPO with that EMA. And the histogram is the difference between the PPO and its 9-day EMA there. You can see when the PPO is below its 9-day EMA, the histogram is negative. And then when the PPO is above its 9-day EMA, the histogram is positive. Now, the little trick I want to show you has to do with the PPO 50, 200, 0. That's the second indicator there. And what I've done is I've eliminated the signal line by putting 0 as that last parameter. So this PPO shows the percentage difference between the 50-day EMA and the 200-day EMA. And you can see that it shows as a histogram when using these parameters, and it has been positive for over 6 months, actually for over a year, actually for over 2 years in this chart. And we can see that it's currently around 3.1% difference. That means the 50-day EMA is 3.1% above the 200-day EMA. And we can confirm that by going to the annotate button there and choosing percentage change. And if I measure the percentage change from that 200-day EMA the red line, and I go up to the 50-day EMA, there you can see we're about 3.1% difference. And so that's what the PPO is telling you. And so I like to use that longer term PPO to get an idea of the long-term trend.